Let's turn our attention back to markets here, talk a little bit about everything that has been going on and could be going on over the next couple of weeks. John Stoltzfus joins us now, Chief Investment Strategist at Oppenheimer Asset Management. John, always good to talk to you, my friend. Let's start with how you've thought about the last week or so of action, where everyone started to notice that the Treasury yield had been coming in pretty considerably. We've had some almost scary moments in the market, but ultimately we're sitting, at your year-end price target and basically at a record high for the S&P.
Well, Miles, when we look at it, we think the action that we've seen over the course of the last week or so has really been not atypical of what you get in a workout market from a great crisis, whether it was the financial crisis or whether it's the current pandemic crisis that we are in a process of exiting. You get a lot of mixed signals, whether it's from economic data, policymakers on Capitol Hill, whether it's coming from the Fed, and then the market itself, which generally always mistrusts the Fed and expects the Fed to make a mistake, even though the Fed has been remarkably sensitive to both growth and slowing since 2008. It's been remarkably good. So we continue to like the Fed here and think the Fed is our friend.
Hey, John, it's Julie here. It's great to see you. We talk about the Fed, the People's Bank of China, the central bank over there just cut their reserve rate. So seeming to imply that there is a little bit of concern about growth there. The growth concerns seem to be perhaps what was driving some of the turmoil that we saw in the markets yesterday. How concerned are you about that? If we do see slowing growth, but still at a relatively historically robust pace, is that enough to fuel continued gains in stocks here by the end of the year?
Yeah, we do think so, Julie. We think that the economy is showing remarkable resilience, okay? And it is also showing, beginning to show, a resistance to the thought that inflation is going to be a longer lasting problem instead of something that is transitory. We think the highly competitive market that in terms of business, hyper competition that has been caused by the advancements in technology, the process of globalization and even regionalization among countries in the world tells us that inflation is not the issue. So we think stocks are the place to be. We think you got to be diversified, however, and that's both growth and value, garpier growth and growthier value. How's that?
That's pretty impressive there, John. Let me ask you, though, I've been searching for the retail investor. They've disappeared over the past month and a half, and a lot of those meme stocks that were so hot earlier in the year, they're now, in many respects, a bear market. Where do you think the retail investor has gone?
Yeah, Brian, I think there's a definition that has to be added to the retail investor. The retail investor today is at least many different components, of course, short-term, intermediate-term, long-term, but it also has to do with the do-it-yourself discounter group that is very much a day trader kind of mentality. Nothing wrong with that, but that's where it's at. And then you have private investors whose goals are intermediate term to longer term, 3, 5, 7 years out. And that process right now is favoring intermediate term investing, as we've seen kind of a blowout in terms of the meme, the frenzy stocks, as life gets real and life gets earnest, and we get closer to an exit, not from the pandemic, not without challenges from the variants, mind you.
John, I'm just curious what folks you're talking to are most concerned with right now. I mean, it's certainly been a rally, like many are, that hasn't been, so believed in. Maybe people came around beginning of this year. What's the tenor of your average conversation these days?
Well, I think Miles, when we speak to investors, the big acknowledgement really is people are beginning to accept the idea that perhaps interest rates will not rise to the extent that interest rates will be high enough to help them meet their intermediate to long-term objectives. And I think that has caused a capitulation among skeptics and bearish investors that has fed into equities. At the same time, the good news is people are not doing this willy-nilly. They're not excited jumping into it. They're asking a lot of questions. They're looking for diversification. Our favorite sectors remain technology, consumer discretionary, barbelled with financials and industrials at this time.
John, let me go back real quickly to what you were talking about on the retail investor. I mean, those very good points. Do you think what we saw in the first half of this year, or maybe 4 or 5 months or so, that retail type of activity, that was a fad, mostly driven by people being at home during the pandemic, and we may not see that ever again?
Brian, I think it was, in part, it was that. Most certainly, it was given birth by the pandemic, and then stimulus checks helped a lot, too, we would think. Nothing like a stimmy check, right, in the mail to help somebody go into commissionless trading on an intraday basis. But what we do believe is that it is the birth of an interest by the millennial generation that is parallel to the interest that the baby boomers had during the tech bubble that continued after that. And the reality is that all generations today have needs to plan for things like retirement, for saving for college educations, for saving for buying a home, what have you. And with interest rates where they are, it really is a time for serious investors, as well as those who like to be players. It's also room for the players. So we don't think the DIY crowd disappears. In fact, with technology the way it is, we expect them to remain, but it's not the core of the market.
All right. Always appreciate your thoughts. John Stoltzfus, Chief Investment Strategist, Oppenheimer Asset Management. John, thanks for joining us. Have a great rest of your summer.